Today is Saturday, February 8th, 2026, and I need to show you something that most financial advisors will never tell you. Right now, domestic gold prices are up approximately 77.5% over the past 12 months. That's an extraordinary return by any measure. Gold ETFs have largely matched this performance. But here's where the story takes a troubling turn. Gold fund of funds, the investment vehicles that millions of retail investors use to gain precious metals exposure, have delivered returns ranging from just 72% to 78% over that same period. Now I know what you're thinking. Mr. AG Asian guy, a few percentage points, what's the big deal? Let me explain exactly why this matters more than you realize. If you invested 1 lakh rupees in gold a year ago, you should have roughly 167,500 rupees today based on the metal's actual performance. But if your FoF delivered 72% instead of 77.5%, you have only 172,000 rupees. That's 500 rupees that simply vanished. Multiply that across larger portfolios, compounded over multiple years, and you're looking at lakhs of rupees in wealth that never materialized. This isn't a rounding error. This is a structural problem that's silently eroding the returns of countless investors who believe they own exposure to precious metals, but are actually holding something subtly different. Before I dive deeper into why this divergence exists and what you can do about it, I want to know where you're watching from today. Drop a comment right now and tell me your city and country. Are you joining from Mumbai, from Delhi, from Bangalore? Are you watching from the United States, from the UK, from Singapore, from the Middle East? I'm genuinely curious about where our community is growing because understanding your perspective helps me create better content for you. And while you're at it, if this is your first time watching one of my videos, make sure you subscribe and hit that notification bell, because the information we're about to cover could genuinely change how you think about precious metals investing. Let me walk you through exactly what's happening with these investment vehicles, why silver is sitting in what veteran traders describe as a coiled spring position, and what the collision of Federal Reserve policy, inflation dynamics, and green energy demand means for precious metals prices over the coming months and years. This is going to be comprehensive, so settle in. The fundamental promise of a fund of funds is simple. You invest in the FoF. The FoF invests entirely in units of the corresponding ETF. The ETF holds physical metal or derivatives designed to track metal prices, and your returns should therefore mirror the underlying commodity. In theory, it's an elegant structure that gives retail investors without demat accounts, or those who prefer systematic investment plans, an easy pathway to precious metals exposure. The reality, according to data compiled from ACMF for the 1-year period, ended February 5th, 2026, tells a different story. The divergence between metal prices, ETF returns, and FoF returns isn't random noise. It's the result of specific structural factors that compound over time. The first factor is expense ratios. Every layer in the investment chain charges fees. The ETF has its own expense ratio. The FoF adds another layer of expenses on top. These costs seem small on a percentage basis, typically ranging from 0.5 to 1.5% annually, but they compound relentlessly. Over a decade of investing, these seemingly minor fees can consume a significant portion of your potential returns. The second factor is timing and cash drag. When you invest in a FoF through a CP or lump sum, your money doesn't instantly convert into metal exposure. There's a settlement period. There's cash held for redemptions. There's the gap between when you invest and when the FoF actually purchases ETF units. During periods of rapidly rising prices, this timing lag means your money is sitting in cash while the metal is running higher. The FoF eventually catches up, but it's always chasing the actual metal price rather than perfectly tracking it. The third factor is tracking error at the ETF level itself. Even ETFs don't perfectly mirror spot metal prices. They hold physical metal in vaults, which involves storage costs and insurance. They may use derivatives for liquidity management. The creation and redemption mechanism that's supposed to keep ETF prices aligned with net asset value does not work instantaneously. During periods of high volatility, ETF prices can temporarily diverge from the underlying metal. When you stack the FoF's tracking error on top of the ETF's tracking error, you get compounding imperfection. The fourth factor is something most investors never consider, which is the difference between domestic prices and international spot prices. Indian gold and silver prices aren't simply conversions of London or New York prices. They incorporate import duties, GST, currency conversion spreads, and local supply-demand dynamics. The ETFs track domestic prices, but those domestic prices themselves can diverge from international benchmarks during periods of rupee volatility or when import policies change. Now here's what I find fascinating about this situation. Most investors have no idea this divergence exists. They check their FoF returns, they see a healthy gain, and they assume they've captured the metal's full performance. They never compare their actual returns against what the underlying commodity delivered. They never calculate how much wealth they've left on the table. This is exactly why financial education matters. Not because the information is hidden, but because most people never think to ask the right questions. Let me pause here and ask you something. How many of you currently hold gold or silver FoFs in your portfolio? And have you ever compared your actual returns against the metal's price performance over the same period? I'm genuinely curious. Let me know in the comments, because I suspect many of you are going to be surprised when you do this calculation. Now I want to shift our focus to silver, because what's unfolding in the silver market right now is something that veteran traders are watching very closely. The data I've been analyzing suggests silver is in what technical analysts call a coiled spring position. It's not dead, it's not euphoric, it's compressed and loaded with potential energy, waiting for a catalyst to release it. Let me explain what I mean by coiled spring, because this concept is crucial for understanding silver's current setup. When a market trades in a relatively tight range for an extended period, consolidating after a move, it's building tension. Buyers and sellers reach a temporary equilibrium. Neither side has enough conviction to break the stalemate. Volume often declines. Volatility compresses. The chart looks boring. But beneath the surface, pressure is accumulating. Orders are building at key levels. Participants are establishing positions for the next directional move. And when the catalyst finally arrives, when something tips the balance, the release of that accumulated tension can be explosive. Silver's price action over recent weeks shows exactly this pattern. The market has shaken off the worst of panic selling. Prices have stabilized in a definable range, but there's no runaway breakout, no euphoric buying frenzy. Instead, you see a mix of accumulation and hesitation. This is classic pre-move energy. The question isn't whether silver will eventually make a significant directional move. It will. Markets always resolve consolidation periods with expansion. The question is, which direction and when? To understand what might trigger silver's next major move, you need to understand the forces currently acting on the market. And the most important force by far is Federal Reserve policy and global interest rate expectations. Jerome Powell and the Federal Reserve are the invisible hand behind every serious precious metals move. Here's the mechanism that connects Fed policy to silver prices. When the market expects aggressive interest rate cuts, real yields tend to fall. Real yields are the return on bonds after subtracting inflation. When real yields are high, holding non-yielding assets like silver becomes less attractive because you're sacrificing meaningful income by not owning bonds. When real yields are low or negative, the opportunity cost of holding silver diminishes substantially. Suddenly, an asset that generates no yield looks competitive because bonds aren't generating real returns either. Right now, the Federal Reserve finds itself in an extraordinarily difficult position. Inflation has cooled from its peak levels, but it's still hovering above the zone that central bankers would consider acceptable. Services inflation remains sticky, shelter costs continue rising, insurance premiums have exploded higher. The headline numbers look better, but the lived experience of inflation for ordinary people remains painful. Meanwhile, the labor market is showing signs of cooling but hasn't collapsed. Consumer spending is moderating but not crashing. The Fed is trying to navigate between two dangerous outcomes. If they cut rates too aggressively and inflation reignites, they'll have to reverse course and hike again, destroying their credibility and extending economic pain. If they keep rates too high for too long, they risk triggering a recession that throws millions out of work and creates its own set of political and economic problems. For silver, this Fed uncertainty translates into a tug of war. Dovish expectations, meaning more rate cuts coming, slower future hikes, or an extended pause, tend to fuel silver bulls because falling real yields reduce the opportunity cost of holding metal. Any hawkish surprise, meaning stronger inflation prints, hot jobs data, or tough language from Fed officials, can quickly pressure silver as yields and the dollar creep higher. The current market mood is leaning toward the view that the era of aggressive tightening is over. Traders are increasingly betting that the next significant Fed move will be a cut rather than a hike. That expectation alone is constructive for silver, even if the path remains choppy and uncertain. But here's what makes silver's situation uniquely interesting compared to gold. Silver is not purely a monetary metal. It's also an industrial metal, and this dual identity creates dynamics that don't exist in the gold market. Gold trades primarily on monetary factors: interest rates, currency values, inflation expectations, safe haven demand. Silver responds to all of those factors too, but it also has massive industrial applications that make it sensitive to economic growth expectations. When the economy is strong and manufacturing is expanding, industrial demand for silver rises. When recession fears grip the market and manufacturing contracts, industrial demand weakens. This dual identity means silver can catch a bid from either direction depending on which narrative is dominant at any given moment. In a risk-on environment where growth expectations are improving, silver's industrial story supports prices. In a risk-off environment where investors seek safety from economic turmoil, silver's monetary story supports prices. The metal can theoretically benefit from both scenarios, though the path and magnitude of gains will differ. What's happening right now is a fascinating collision of these two narratives. On the monetary side, government debt levels across major economies have become mathematically concerning. Central banks face impossible choices between allowing yields to spike and destabilize their economies or intervening with money creation that debases their currencies. The long-term trend favors hard assets as stores of value. On the industrial side, the structural demand story for silver has never been stronger. And this is where I want to spend some time, because most investors dramatically underestimate how important this is. Silver's role in green energy and electrification is not a minor footnote. It's becoming a defining characteristic of the metal's demand profile. Let me walk you through the specific applications. Solar panels are perhaps the most significant demand driver. Silver paste is a critical component in photovoltaic cells. Every solar panel installed anywhere in the world contains silver. As the global push for renewable energy accelerates, as countries race to meet decarbonization targets, solar installation capacity is expanding at unprecedented rates. China alone produces 80 to 90% of the world's solar panels, and their manufacturing capacity continues growing. India is aggressively expanding solar infrastructure. Europe and the United States have committed to massive renewable energy investments. Each of these installations requires silver. This is not speculative future demand. This is actual silver being consumed right now in quantities that are increasing year over year. Electric vehicles represent another major demand vector. EVs and their charging infrastructure rely on advanced electronics where silver's superior electrical conductivity makes it irreplaceable. Every electric vehicle contains more silver than a traditional internal combustion vehicle. As global automotive fleets electrify, this demand grows structurally regardless of short-term economic cycles. The transition away from fossil fuels is not a temporary trend. It's a multi-decade transformation that will consume enormous quantities of silver. Then you have the broader electronics sector. Smartphones, computers, sensors, 5G infrastructure, and the entire connected device ecosystem all use silver in various components. The expansion of artificial intelligence infrastructure, including the massive data centers required to power AI applications, adds another layer of demand. These facilities require sophisticated electrical systems where silver plays critical roles. Medical devices and emerging technologies add further applications. Silver's antibacterial properties and unique chemical characteristics keep creating new use cases in healthcare and high-tech applications. Here's what all of this means for the investment thesis. Even if the global economy experiences a cyclical slowdown, the structural trend toward electrification, decarbonization, and digitalization continues. Short-term dips driven by macro fear can be framed as accumulation opportunities for investors who understand the long-term industrial demand trajectory. I want to hear from you on this point. How many of you were aware of silver's industrial applications before watching this video? Did you know about the solar panel connection or the EV demand story? Let me know in the comments, because I want to understand what aspects of this thesis are new information for our community. Now, let's talk about one of my favorite analytical tools for understanding precious metals, which is the gold-silver ratio. This ratio simply tells you how many ounces of silver you need to buy 1 ounce of gold. It's calculated by dividing the gold price by the silver price, and it reveals something important about relative value. Historically, this ratio has averaged around 50 to 1 over extended periods, though it fluctuates significantly. When the ratio stretches to extreme highs, meaning you need many more ounces of silver to buy 1 ounce of gold, silver is considered undervalued relative to gold. When the ratio compresses to extreme lows, silver is considered overvalued. Recent years have seen the ratio trade at elevated levels, suggesting silver has lagged gold's performance. This creates a specific opportunity that contrarian traders monitor closely. If the macro environment continues favoring precious metals broadly, silver has room to play catch-up against gold. That catch-up move is exactly what fuels the legendary silver squeeze narrative. The idea that once momentum starts, silver can move sharply higher as both investors and industrial buyers compete for limited supply. During previous precious metals bull markets, the gold-silver ratio didn't just drift toward its average, it crashed dramatically. In some historical periods, the ratio fell to 30 to 1, 20 to 1, or even lower during mania phases. This ratio compression is why silver often delivers larger percentage gains than gold during precious metals bull markets. Silver is the leveraged play on the broader thesis. However, and this is important, the gold-silver ratio is not a timing tool. The ratio can remain elevated for longer than anyone expects, particularly when economic growth concerns weigh on silver's industrial demand profile. Smart traders use the ratio as one input among many, rather than treating it as a precise signal. Let me explain another crucial factor that's shaping silver's trajectory right now, which is the strength or weakness of the US dollar. Because silver is priced in dollars on global markets, every significant move in the dollar index directly impacts silver's price. A stronger dollar typically weighs on silver for a simple reason. When the dollar strengthens against other major currencies, it takes fewer dollars to buy an ounce of silver. The nominal price in dollars falls even if silver's value in other currencies remains stable. Additionally, a stronger dollar makes silver more expensive for non-US buyers, reducing global demand. Conversely, when the dollar weakens, silver prices typically rise. A weaker dollar means you need more dollars to buy the same ounce of silver, and the metal becomes cheaper for international buyers, potentially stimulating demand. Right now, dollar sentiment is genuinely split. On one side, relatively high US interest rates and a resilient US economy compared to other major economies have kept the dollar from collapsing. On the other side, the expectation that the aggressive hiking cycle is finished and that future cuts are probable caps the dollar's upside potential. For silver traders, this means watching key US economic data releases is essential. Consumer price index reports, PCE inflation data, employment figures, and Federal Reserve speeches can flip dollar sentiment quickly. And when dollar sentiment flips, silver tends to react in real time, often with exaggerated moves in both directions. Now I want to address the sentiment and psychological dynamics in the silver market because they're impossible to ignore if you want to understand price action. The silver market has always attracted passionate participants. On one side, you have the silver stacking community, individuals who accumulate physical bars and coins over years, focused on long-term wealth preservation, and often motivated by distrust of fiat currency systems. These stackers are generally not sensitive to short-term price fluctuations. They view dips as buying opportunities and have multi-decade time horizons. On another side, you have short-term speculators and traders who chase momentum in futures, contracts, and mining stocks. They're seeking quick profits from silver's volatility and have no emotional attachment to the metal itself. They'll go long or short depending on what the charts suggest. Then you have the occasional waves of excitement around a new silver squeeze, inspired by events like the 2021 social media-driven buying frenzy. The narrative goes that paper silver markets are over-leveraged compared to available physical supply, and coordinated buying could force a dramatic price spike as short sellers scramble to cover positions. These different participant groups create a market with distinctive characteristics. Silver can stage powerful rallies when sentiment aligns positively, as different buyer types pile in simultaneously. But it can also experience brutal sell-offs when sentiment sours, as the speculative crowd exits quickly while stackers simply stop buying temporarily. Understanding which type of participant is driving any particular move helps you interpret price action more accurately. A rally driven by industrial buying and stacker accumulation has different implications than a rally driven by speculative fever. Similarly, a correction driven by forced liquidation of leveraged positions differs from a correction driven by fundamental demand destruction. Right now, my read on silver sentiment is cautiously optimistic. Bulls are present, but not euphoric. Bears are vocal on every pullback, arguing that growth concerns and dollar strength will cap upside. This balance of competing narratives is actually fertile ground for a larger move. Once one side loses conviction, the other can drive a sustained trend. Let me talk about something that should concern every precious metals investor, which is the gap between what you think you own and what you actually own. This connects back to where we started with FoF performance divergence, but extends to broader questions about investment structure. When you buy a gold or silver FoF, you own units in a fund that owns units in an ETF that owns metal or metal derivatives. You're 2 layers removed from the actual commodity. Each layer introduces costs, timing delays, and potential tracking errors. The further you move from the underlying asset, the more these frictions compound. Physical bullion eliminates some of these concerns, but introduces others. Storage costs, insurance, security considerations, and liquidity challenges when you want to sell. There's also the question of authenticity and dealing with reputable dealers. ETFs sit in the middle. They're more efficient than FoFs in terms of expense ratios and tracking, but they still involve counterparty risk and management expenses. Not all ETFs are structured identically, and understanding whether your ETF holds physical metal or uses derivatives matters for risk assessment. The point isn't that one structure is universally superior. The point is that informed investors understand what they actually own, what costs they're paying, and how those costs impact long-term returns. The FoF return divergence we discussed earlier is a symptom of insufficient attention to these structural details. Ask yourself honestly, do you know the exact expense ratio of your precious metals investments? Have you calculated the cumulative impact of those fees over your expected holding period? Do you understand whether your fund holds physical metal or derivatives? If you can't answer these questions confidently, you have homework to do. Now I want to give you a framework for thinking about what happens next with silver, because having a structured approach is more valuable than any single prediction. There are 5 forces currently shaping silver's trajectory, and the interaction between them will determine price action over the coming months. The first force is Federal Reserve policy trajectory. If the Fed pivots toward rate cuts and real yields decline, this removes a major headwind for precious metals and could trigger significant buying. If inflation reaccelerates and forces the Fed to maintain restrictive policy longer, precious metals face continued pressure from yield competition. The second force is dollar direction. A sustained dollar decline would likely catalyze silver buying from international participants. A continued dollar rally would maintain downward pressure on dollar-denominated commodity prices. The third force is global economic growth expectations. Improving growth expectations support silver's industrial demand narrative but might reduce safe haven flows. Deteriorating growth expectations could trigger safe haven buying, but might weigh on industrial demand estimates. Silver's dual identity means it can theoretically benefit from either scenario, but the mechanism differs. The fourth force is physical versus paper market dynamics. If physical demand continues outpacing easily available supply, we could see the kind of spot futures disconnect and premium expansion that signals genuine scarcity. This would be powerfully bullish for prices, as paper markets eventually adjust to physical reality. The fifth force is investor positioning and sentiment. If speculators are heavily positioned in one direction, they become vulnerable to forced covering if the market moves against them. Understanding the current positioning helps anticipate potential squeeze dynamics in either direction. These 5 forces don't move independently. They interact in complex ways. Strong growth might lead to Fed hawkishness, which strengthens the dollar, which pressures silver prices even though industrial demand is improving. Or Fed dovishness might weaken the dollar and boost silver even during an economic slowdown. The combinations are numerous, which is why having a framework matters more than having a single prediction. Let me give you my honest assessment of where we stand today. Silver is at an inflection point. The technical setup shows consolidation that typically resolves with directional expansion. The fundamental picture includes both structural tailwinds from industrial demand and potential headwinds from dollar strength and growth concerns. The sentiment picture shows cautious optimism without extreme positioning in either direction. This is exactly the kind of environment where significant moves originate. Not when everything is clear and everyone agrees on direction, but when uncertainty creates compressed positioning and accumulated tension. For long-term investors with multi-year time horizons, periods like this can represent accumulation opportunities. The structural thesis around electrification, decarbonization, and monetary debasement hasn't changed. Short-term volatility is noise against that longer-term signal. For shorter-term traders, this environment requires patience and discipline. Trading a compressed market before it breaks out can be frustrating and expensive as positions get stopped out repeatedly. The better approach might be waiting for a confirmed directional break and then positioning for the expansion move. What I would caution against is complacency. Too many investors assume their FoFs or ETFs are perfectly tracking the underlying metals and never verify. Too many investors ignore the structural costs eating into their returns year after year. Too many investors don't understand what they actually own or why their investment behaves the way it does. The gap between metal returns and FoF returns that we discussed today is not going away. It's structural. It will persist as long as these products exist. The question is whether you account for it in your expectations and planning or whether you remain ignorantly optimistic about returns you're not actually receiving. I hope this analysis has given you a clearer framework for thinking about precious metals, both the investment vehicle considerations and the fundamental factors driving prices. These are complex topics that deserve careful attention rather than the superficial treatment they often receive in mainstream financial media. Thank you for spending this time with me today. I genuinely appreciate every single one of you who watches these videos, engages in the comments, and thinks critically about your investments. Building this community of informed, independent thinking investors is something I'm deeply passionate about. If you found value in today's analysis, please take a moment to hit that like button. It seems simple, but it genuinely helps the algorithms show this content to more people who need to see it. Subscribe if you haven't already, and turn on notifications so you never miss an update. Before you go, I want to leave you with a question. Given everything we've discussed about FoF performance gaps, silver's coiled spring setup, and the forces shaping precious metals markets, what's your current approach? Are you holding FoFs and now reconsidering? Are you waiting for silver's next directional move before positioning? Have you calculated the actual costs eating into your returns? Share your thoughts in the comments because the discussion there is often as valuable as the video itself. This is Msar AG Asian Guy, reminding you to stay curious, stay skeptical of easy narratives, and always do your own research. I'll see you in the next video. Until then, take care of yourselves and take care of your portfolios.